The FOMC cometh. What will Jerome Powell say tomorrow about rate hikes, and how's the market going to respond? That's coming up on 3 Minutes on Markets and Money. Today starts the two-day meeting of the FOMC. Of course, Jerome Powell heading that up as chairman. Yesterday, we talked about the fact that markets were going to open lower, but that we could very well see a rally heading into the FOMC meeting simply because of all the selling that we had last week. Markets had gotten oversold on a short-term basis, and we actually did see that. Markets did rally off of this support line going back to these May lows, and that's encouraging here because markets continue to kind of hold support right now despite the fact that we're seeing a lot of downward pressure as of late in the market. So that buying very welcome yesterday, particularly after last week's rout overall. Now, tomorrow the Fed will announce their next policy change, which will most likely be a 75 basis point rate hike with an outlook that they will continue to hike rates to combat inflation. As the Fed said previously at Jackson Hole, that they are okay with below trend economic growth. Now, that's an important statement because earnings come from economic growth. So if the Fed is okay hiking rates and slowing economic activity, that means earnings have to come down even more than they have already. That's going to potentially put more pressure on stock prices later this year as prices have to start to accommodate for lower earnings expectations. Earnings have come down, but not nearly enough to accommodate for below trend economic growth, not at this juncture anyway. The Fed remains focused on inflation as the big factor, and their goal is to get inflation down to 2% from currently running over 8%. So the Fed hiking 75 basis points tomorrow won't be a surprise. The expectations are they will then announce continued rate hikes. Now, markets currently expecting 50 basis point hike at the next meeting, another 50 to wrap up the year, a 25 basis point hike in 2023, the Fed stopping at basically 4.5% on the Fed funds rate. But then interestingly, the market is now expecting an immediate reversal of the Fed starting to cut rates. Now, the only reason the Fed's going to be cutting rates in 2023 is because, well, the market is no longer acting orderly. You know, we talked about how there's been very low volatility in the markets, the bond market behaving, credit spreads not blowing out right now. So again, the only reason the Fed's going to immediately reverse rate hikes to rate cuts is because the orderly in the market has now become disorderly. Recession is threatening, or we're in a recession, and there is risk of financial instability. So once we start seeing the Fed cut rates, that won't be the time to actually be buying equities, because as the Fed cuts rates at that point, they'll be combating the risk of whatever financial instability has shown its face in the markets, and the Fed will be fixing that. So again, where the opportunity to buy equities will be is most likely when the Fed is moving back towards zero on lending rates next year. We'll talk about that then when we get there. That's 3 Minutes on Markets and Money. See you back here tomorrow.